Financial Massacre 2025, the currency war and ghosts from the past. The year 2025 is witnessing fierce and unpredictable upheavals in the global financial landscape. In a world seemingly recovering from the seismic economic shocks of the post-pandemic era and prolonged geopolitical conflicts, another undercurrent is quietly taking shape, not a war of bombs and bullets, but a far more sophisticated and ruthless conflict. The financial massacre of 2025. The storm's origin lies not in manufacturing or technology, but deep within monetary policies, exchange rates, and manipulations of the international financial system. While global media is engrossed in tariff and trade disputes among superpowers, few realize that this is merely the surface layer. The real weapon being deployed, with a destructive force far beyond expectations, is the currency war. This is not a new concept in the history of global economics. Japan was once a victim of such a strategy in the 1980s, with the Plaza Accord delivering a critical blow that plunged its economy into stagnation for more than 2 decades. Now, Taiwan is being pushed into a similar position, facing the risk of becoming the next sacrificial pawn in the grand game of global finance. It all began with a series of seemingly harmless signals. The new Taiwan dollar suddenly surged in value over a short period, while international investment capital appeared to flow in at breakneck speed. The media and some analysts were quick to hail this as a sign of a stable, trustworthy economy attracting foreign capital. Yet behind this dazzling facade lies a meticulously calculated scheme, orchestrated by financial powers operating behind the U.S. government, with the newly appointed Treasury Secretary, Bestent, playing a central role. He is increasingly seen as the architect of a new global financial coordination campaign aimed at maintaining the U.S. dollar's dominant position. The abrupt exchange rate surge not only rattled Taiwan's financial markets but also jeopardized its entire export structure and manufacturing base. A currency that appreciates too quickly can become a double-edged sword, and in this case, it's a preset trap. The financial massacre of 2025 is no longer a hypothesis. It is gradually unfolding according to a premeditated script. Financial Massacre 2025, the currency war and the shadows of history. For nearly a decade, the world has grown familiar with the term trade war between the United States and China, a confrontation seemingly centered around tariffs, trade balances, supply chains, and national income flows. But in 2025, attention has suddenly shifted to a new battleground, more subtle and far more dangerous: the currency exchange war. Unlike conventional wars involving weapons or visible trade barriers, a currency war is a silent yet brutal contest. In it, superpower nations need not fire a single bullet to cripple an economic rival. By disrupting monetary stability, overturning supply chains, and choking growth with the invisible hand of the market, they can achieve devastation. The first victim of this war is Taiwan, a semiconductor and tech manufacturing hub on which the world heavily depends, yet also a hotspot of geopolitical and military tensions. Alarmingly, the scenario Taiwan is now enduring is not unprecedented. It is a chilling replica of what happened to Japan in the 1980s, when it was forced to adjust its exchange rate and subsequently fell into the so-called lost decade. When the U.S. administration appointed Thomas Bestent as Secretary of the Treasury in early 2024, many observers dismissed it as a temporary political maneuver. But within just a few months, Bestent proved he was no ordinary politician. He did not come from Wall Street, nor was he an academic from the Ivy League. That Bestent possessed a weapon far more dangerous: a strategic mindset that fused political power with international finance. He was not concerned with short-term trade figures. What he sought was a new financial order, one in which the United States would lead not only through military might but through the invisible power of the U.S. dollar. Under Bestent's orchestration, a network of investment funds, intermediary financial institutions, and international financial intelligence units was quietly activated. Taiwan was the first on the list, not because it was weak, but because it was too strong and too critical to both China and the rest of the world. Attacking Taiwan financially became a way for Bestent to squeeze China's economic and technological influence, without firing a single shot. In April 2025, a financial shockwave hit Asia. The new Taiwan dollar TWD surged by more than 10% in just 48 hours. There was no natural disaster, no political upheaval, and no breakthrough economic data that could explain the phenomenon. At first, media outlets attributed the spike to renewed investor optimism in Taiwan's booming semiconductor sector. But an independent investigation by a team of economists in Zurich revealed the truth. Over $50 billion USD had been funneled into Taiwan's financial markets by financial institutions with ties to the U.S., through branches in Hong Kong, Singapore, and the Cayman Islands. This was not a natural wave of investment. It was a targeted currency assault, planned, orchestrated, and executed with precision by a transnational financial apparatus with a single objective: to drive up the new Taiwan dollar, erode Taiwan's export competitiveness, and trigger internal instability. The consequences were swift and severe. Leading export giants such as TSMC, Foxconn, and ASE Group began to report projected revenue drops 10–15% within a single quarter. Taiwanese components suddenly became more expensive, and orders began shifting to lower, Southeast Asian countries. In the stock market, panic selling ensued. The TAIEX index plummeted more than 15% within 2 weeks. Many small and medium-sized enterprises went bankrupt, unable to manage the imbalance between rising input costs and declining output revenue. Hundreds of thousands of workers faced indirect unemployment. Taiwan's central bank was forced to intervene, offloading over $80 billion USD in foreign reserves within a month to curb the currency's rise. But the more it intervened, the more market confidence eroded. Panic spread. International investors began to flee. A localized financial crisis began to take shape. Looking back at history, one doesn't have to look far to see the shadow of the 1985 Plaza Accord, when the U.S. coerced Japan and other G7 nations to appreciate the yen in an effort to reduce America's trade deficit. The result: the yen surged over 50% in 2 years, leading to the collapse of Japan's asset bubble and 2 lost decades of economic stagnation. Today, that script is being replayed in Taiwan, only this time, it's more sophisticated. There's no need for a formal agreement. With control over investment flows, media narratives, and anonymous financial mechanisms, currency rates can now be weaponized, a modern tool of warfare. Taiwan is not the only country affected. Following the surge of the new Taiwan dollar, a wave of pressure swept across other currencies such as the South Korean won, Thai baht, and Malaysian ringgit, all of which began appreciating due to an influx of speculative capital. Emerging markets across Asia entered a state of high alert. Several central banks were forced to raise interest rates to defend their currencies, a move that, in turn, strained domestic businesses as borrowing costs soared. The risk of defaults grew. A wave of localized recessions began to ripple across the region. What was once a shadow war of exchange rates had now left visible damage on financial statements, market indices, and the daily lives of millions. Professor Martin K. of Oxford University described this as a digitally engineered financial massacre. According to him, if the U.S. continues to manipulate exchange rates to strengthen the dollar and weaken offshore technology hubs, the entire Asian continent could plunge into a prolonged period of instability lasting over a decade. An internal report by the Bank for International Settlements (BS) echoed this concern. In Q2 of 2025, exchange rate volatility in Asian economies rose to 2.4 times the 5-year average. A direct warning was sent to Asian governments. Without a collective financial defense mechanism, no one will be spared from this spiral. Amid rising tensions, leading financial experts from Singapore, South Korea, and Malaysia called for the establishment of a soft Asian monetary alliance, a mechanism for sharing capital flow intelligence, coordinated currency defense, and joint responses to strategic speculative attacks. In Taiwan, the government is now under immense pressure to control capital flows and build a financial defense infrastructure. Policymakers are being urged to urgently consider the following measures: establish a national currency defense fund, restrict short-term speculative foreign investments, expand the domestic consumer market to reduce reliance on exports, diversify technology supply chains to avoid single-direction vulnerability. The financial massacre of 2025 is not a transient event. It is the result of a long-term strategy where currency is used as a geopolitical weapon and the free market becomes a regulated battlefield. The ghost of the Plaza Accord still lingers, but this time it comes not in the form of formal agreements, but through electronic capital flows, financial data, and the covert actions of transnational investment conglomerates. Unless Asian economies realize they are being pulled into an asymmetric financial war, the region may soon replay Japan's tragedy, only this time on a much larger scale.